So you hear all this stuff on the news about, people with investment properties and all that stuff. Well, when you look at the data, most people just have, if they do have an investment property, it's just one. That's, if you look at the ATO or the ABS data, most Aussies who have an investment property, they've just got the one. So the question is, Martin, welcome to Retire Right today. The question is, coming up to retirement, usually someone may have had a property for many years and it's always been, we'll sell that as part of our retirement. Or it's like the pre-retirement discussion with a financial advisor is a flashpoint. Often everything just gets put on the table to look at. Is that a fair comment?
Yeah.
And I think for those with investment properties, it does 100% form part of the discussion because you can look at it a couple of ways. Well, we've got a big chunk of money sitting there that we can sell and live off, for example.
They might have an income stream coming, there might be rent coming in.
Yeah, or exactly the other side of it, well, we kind of keep that investment property because we're happy with the location, we've got some other stuff going on. We're just seeing that as a $700 a week annuity coming into our portfolio.
Yeah.
So that's kind of, we put it all on the table. But the question today, Ross asks, selling an investment property that has capital gains tax, splitting it into the husband and wife super, utilising the carry forward concessional contributions.
Here we go.
Let's go. Giddy up. As you if you're a regular, you'll know my voice. It's Glen James, joined by Martin McGrath from Financial Edge. We'll get into the podcast.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Rightio. So I love these questions. Martin, can we make an assumption, round numbers, they paid $500K for the property, the investment property is now worth, are you happy with $1 million?
Makes the maths easy, yep.
Let's giddy up. We've got a gain, and everyone, we're fundamentalists here. We're cutting out depreciation, add back to cost bases and all that stuff.
Keep it simple.
Keeping it simple. The cost base, $500K, sale price $1 million. We've got a $500,000 gain.
And we're assuming 50-50.
We're assuming that
the
property is owned 50-50. Actually, I'm going to send this to a friend of mine who are late 30s and they just sold an investment property. And I'm kind of hinting with them, like, guys, I think we need to look at putting some money in each super. So this doesn't, because we don't know Ross's age.
No, that's fair, yep.
Hypothetically, I will say Ross, well, it really doesn't matter. In theory, it doesn't matter because this is a play of potentially reducing capital gains tax.
Yeah. Most of what I'm about to say applies at least up until the age of 67.
Yeah.
Rules beyond that might be a bit different, but yeah, whether you're 27 or 37 or 57, they can apply.
Can I also carve out if you have a super balance over 500?
Correct, per person.
We'll carve that out and we'll get to that.
Yeah.
So we'll assume that we've got a 500,000 gain. We'll assume that Ross has, it doesn't matter what's in his super. We'll just assume 100K. And we'll assume Rose has also 100,000 in super. Not that it really matters. The property's in each name. I was going to assume something else, but I forget. I think we're just assuming they both had under the 500,000.
Yeah.
Because I can send this to my friends who are under 40.
Yep.
So talk to us, again, I want to just step back. The way to get money into super, Martin, there's broadly 3 ways.
Yeah, fair. I assume we got the same three.
Yeah, I wonder what our third one is. I think we'll arrive there, but the first one?
We'll go concessional contributions.
Yeah.
And that's what we're going to talk about today. So concessional contributions are contributions into super that get taxed inside of super, but also save tax outside of super. Either save you personally tax if you're doing it, or it saves your business's tax if you'll work for someone else. So that's a concessional contribution. The most common one is the money that your work puts into super for you. That's a type of concessional contribution.
And this episode is going up at the end of pretty much the end of May, start of June in 25. So from 1st of July, it's 12%.
12%.
Yeah. So, and that current limit is
30,000 per person per year. So if you earn, just to make the maths easy, $100,000, your work would put in $12,000 into super. That counts as part of your cap of 30, but it leaves you $18,000 a year that you don't have to use. But if you want to, you could salary sacrifice through work, or you could do directly with your super fund, which is kind of what we're going to talk about today.
So I could literally, if Ross was earning $100,000 throughout the financial year, his work was going to put $12,000 in. I could literally at the 1st of June transfer $18,000 across and tell my super fund to claim that on tax.
Back on tax, yep.
And then the super fund would take 15% off that for tax, but he would, in theory, earn $18,000 less outside of super, which gives Ross the
deduction on his tax return
overall. And this is the thing with financial advice. When you do these super strategies, you actually have to really step back and look at your life as a whole, where on balance overall, I'm paying less tax. Just there might be some shuffling between the super and non-super.
Yep.
And overall, I'm paying less tax. Overall, that's good for Glenn James or Ross, assuming they live until after age 60 or 65.
Yeah.
So we'll also assume that Rose has the same job.
Yep.
And she's got a $30,000 cap, and she's got a spare $18,000 a year. Now, the second way to get money into super,
a non-concessional or voluntary contribution,
or a post-tax contribution,
post-tax, after-tax contribution,
Yep.
which is just picking some money that's in your bank account after you've been taxed on it and moving that into super. That one, you don't save any tax personally, but also importantly, you don't pay that 15% inside of super. That current limit is $120,000 per person per year. That is a use it or lose it limit. You can do a bit more if you really want to get excited with a bring forward, but maybe just for today we'll leave that as that. That's a voluntary contribution into super.
And I will say, if you look back a couple of weeks ago at our episode that we did that was a bit of a super component nerd out, got a bit technical, the money that you put in, the $120 a year as a non-concessional contribution, that falls into the tax-free column. And the money that you put in and claim on tax, or your employer puts in and claim on tax, that goes into the taxed.
Yep.
Because the money has been taxed.
Yeah.
At a super level. So in theory, that 120 non-concessional goes in and it sits there as tax-free. Well, no, it has paid tax, but
somewhere
outside super.
Yeah.
Okay. The third way, did we get on the same?
I'm going with downsizer.
Oh, that's exactly what I was going with as
Very
well.
good. Okay. So a downsizer.
There's actually probably a fourth way as
there's
well.
a few. There's a downsizer actually kind of, in theory, falls under it's a type of non-concessional.
Yeah.
It just has its own extra limit. So a downsizer refers to a downsize of your home or sale of your home. You need to be over the age of 55 for this to be eligible, and you can put up to $300,000 tax-free into super
Each.
as one-off each. So spouses can put $300,000 in each. Over the age of 55, need to have lived in that home you're selling. You need to have owned it for over 10 years. And I've separated those sentences because they are separate. You don't need to live and own it for 10 years. You need to have lived in it for a period of time, whether that's 6 months or 6 years or 10 years. But you definitely need to have owned it for over 10. And you need to put the money in.
So that investment property worth $1 million will go and kick your tenant out, live in it for 10 minutes.
6 minutes, yeah.
And then go, let's now sell it you still have to pay some CGT on the portion that was an investment property, but in theory, you could get more money to super.
Check with your own advisor on that one.
Yeah, but we're right.
Yeah. And the money on that one in particular has to go in within 90 days.
Yes.
Of settlement. So that's a downsizer. That's kind of that third type of contribution.
The fourth and fifth way that you could technically get money into super, and we'll move on because it's not relevant, it could be a TPD claim that the money insurance policy is in super. So, for example, just on that, because I just want to teach people, if you had a super claim, a TPD claim in super, and they paid $500,000, you could leave that money in the super environment. You don't have to take it out.
Yep.
The fourth way, I don't know if I emailed you this, my self-managed super fund effectively had to sue someone a couple of years ago, and I got a settlement because of some issues that happened. And I said to Martin, do I have to pay freaking contributions, like income tax on that? And I do.
Yeah, I saw that answer, yeah.
So anyway, so back to Ross and Rose. So I just wanted to set all that framework. We've got the $500,000 gain. We want to, like my comment, overall in our total financial situation in our life, reducing CGT by using super.
Super. So let's, I suppose, start with what is CGT, or is there a capital gain? Is this been investment? Yes, it's an investment property. Let's assume they've lived in it. So they've made $500,000 profit. Does that mean they have to give $500,000 of tax? No, it doesn't. But part of that is assessed. So they made a profit of $500,000. Have they owned it for more than a year? We're going to assume yes. They've made a gain like this. So good news is you get what's called the general CGT concession of 50%. So that gain gets halved straight away. So now we're down to $250. So good news, $250 is tax-free. Then that $250, it gets split between the owners.
Because we own 50-50 each.
So $125,000 each has to be declared on our personal tax returns.
So that basically that $125 this financial year, if they earned $100,000 from their income, taxable income, no other investments, nothing else, at the end of the year, on paper, it will say taxable income $225,000 each.
Yeah, and I think that's important because even with clients or prospects that we speak to, what's the capital gains tax rate? There is no capital gains tax rate. The capital gains goes into your personal tax return and often on top of your other income. So just because your wages are taxed a certain rate, this will go in on top of that. And in Australia, personally, we have a sliding scale in tax rates, a marginal tax rate system. So the more you earn, the higher ratio of tax that you pay. So they would each need to declare $125,000 capital gain on top of their wages.
Now, we could do the actual. Do you want to maybe do the actual numbers? Can you maybe just go to the tax calc and do 225, what that would wash up? And what I'll do, I'll just talk about, so the question here, using the carry forward concessional contributions. So what that is, as a refresher if you're a regular here, at any one time, you can effectively look back at the last 5 years. So over the last 5 years, if Ross and Rose, really simple, and we'll just assume that $100,000 a year for the last 5 years, we'll assume that the SG was $12,000 each year. Over the last 5 years, they're allowed to do these catch up or carry forward contributions to fill that plug, because ordinarily, even if we did, let's have a look here. Yeah, so over the last 5 years, they've basically, anyone has had that $30,000. Well, there's a carve out because they include what the limits were. So before the concessional contribution was $30,000, it was 27.5. Was it 27.5 or 27?
Yep, 27.5.
Yeah. So it does stagger with as they've increased, but just to keep it really simple, over the last 5 years, even if they didn't work, there's $150,000 assuming there was 30 grand,
Yep.
that
Carry
can be
forwards.
used as carry forward.
Yeah.
So basically what we're doing is we're saying over the last 5 years, there could be 18 grand a year or $90,000 spare in each person.
They could put into super. Yep.
So that means how much tax would they pay on 225?
So I'll give you this. So on their 100,000 wages, they're already going to pay 23,000 in tax.
Yeah.
Their employer would take that out.
Yeah.
On the additional 125, they would have to pay 49,000 in tax, bringing their total tax bill to 72,000.
Yeah.
So they've already paid the 23. That's already been taken out.
Yeah.
When the house sells on the 1st of February, does the taxman ask for 49,000 then? No, they don't.
We'll wait to the wash up.
When they go and see the accountant or do it online 6 months later, that's when you get the bill for the 49,000 that needs to be paid.
Yep. So the question is, can we somehow reduce this $49,000 using super to make our overall tax position more favourably? And we'll let you know the actual outcome right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Given that we've got $90,000 assumed that we can use in this scenario, can you put what the tax would be based on, it would be the 125 take away the 90, yeah?
Yep.
35. So an extra 35,000. So 130, that's what, 135. What the tax would be on 135K?
That answer is 34,000 in total.
Yeah.
So they've already paid 23, so it's an extra 11,000.
Yep. Cool. So 11,000 extra doing it that way. Now, when that money goes into super, we claim it on tax. So outside super, the accountant just does 135 income. Mm-hmm. But inside super, the super fund, if we drop 90 grand on there,
You have to pay 15% tax on
it's
that.
13.5 grand each.
Yep.
So this is overall, we've still had to pay 13,500 in the super fund and 11 outside, yeah?
Yep.
Gives us 24,500. No, 24,500.
Compared to 49,000 if we don't do anything.
Yes. So, what do you say, 49? So that's...
It's half.
Yeah, 24.
The
maths, I'm like, hang on, how weird is that? So this strategy, if you times that by 2, the couple have saved $50,000 in tax.
Yep.
But the saving...
But if they don't do anything, they basically got to pay in round figures.
I'm still shook how that was the same amount.
If only we rehearsed it this way, we didn't. But yeah, if they don't do anything, it's about $100 grand personal tax bill.
Yeah.
If they go and put, we're saying 90,000 each into super, that personal tax bill comes down to about 22,000 or 23,000 or thereabouts. So they're going to drastically reduce their personal tax bill combined.
Yeah.
Because it was about 11,000 each they're going to have to pay.
Yeah.
So they've saved themselves $70,000, $80,000 or $78,000 or whatever in personal tax.
Yep.
But obviously they've put 180,000 into super. So that bit gets taxed. They have to pay 26,000 in tax on that, but they've saved themselves overall 50,000 of physical tax that hasn't gone to the tax office. Their super has more money because the super's got that contribution. But again, if they're 59 or they're 62, we're definitely doing this because you can get the money back pretty quick. I'm not saying your friends that 35 shouldn't do it, but obviously that's a consideration at this level. But basically at that point, every dollar you're putting in, because personally they're going to be up at the 47% tax bracket for a portion of this. So do I want to do nothing and pay 47% on some of it, or do I want to put in some into super and pay 15% of it? That's a pretty healthy saving on that money. and definitely something that could and should be explored.
So what I'm basically working out, and you can at me in the YouTube comments, it's weird numbers, of the $1 million that lands in their bank account, they in theory have to put aside no, that's not right. They need to put aside the 90 each. I'm just trying to work out like the net wash up, and this is what we probably should prepare.
I'll trust your numbers, but on my head, $1 million of cash, do nothing, you pay $100,000 in tax. You've got 900 left in personal, but you've got nothing extra in super.
Yeah, and that's I just wanted to get
so that's
to
option A.
Yeah, because we need to know. You've got to kind of work out what.
But option B, let's go. We put that into super.
Yeah,
you got your $1 million. You put 180 into super.
That's
You then still need to pay 22,000 in tax.
That's
So you're left with about $790.
Yeah, $798.
$790.
Yeah. So you've got to.
So personally, you've got less cash.
And that was what I was getting at. The total cash position, the trade-off is you wash all this up, save $50,000 in tax at the expense of moving $180,000 not touchable right now.
Correct.
So you've got $800,000 that you can play with in your own money.
In your own money. Yeah. So if you've only got a $600,000 mortgage to pay off, that's the way to go. If you've got, let's say, you bought a second rental property or you've got a home mortgage you want to pay off, well, maybe you need the whole $900,000 of cash. But if you...
And that's the dance. And so if I go back to my friends, they've still got a mortgage. They've got young kids. And they're like, oh, we just want to smash the mortgage. I'm like, yeah, I know, I get that. But is there a way that we can do a bit of both?
A compromise. And in this case, it might be, we'll bring you down to at least get from the 47% bracket down to the 39% bracket. Or get down to the 32% bracket. That you still, there's going to be a point where you don't want to go too low. But also at these levels, the assumptions we're using, again, depends on age, but I would be fairly aggressive the older you are and maybe slightly more conservative the younger you are. But you've got to look at, as you said, the whole picture together, your other situation. And I'll also throw this in at the same time because I do see this sometimes is you sell a house in February, you've got the $1 million. You go put all that to work. The $100,000's not payable till 6 or 12 or 9 months later. You and I have calculated that $100,000 today, but a lot of people don't, and they get the tax bill later and go, $100,000, where am I going to get this from? I don't have this money anymore. Well, the HO is saying, well, you've got this tax bill because you got that $1 million earlier in the year. So if and whenever you're selling a rental property, A, should be potentially getting some advice, but B, if you've calculated that tax bill, I always encourage the people I work with to put that money aside today. That's gone. You have to pay to the ATO today, but you've kind of got to assume that $100,000's gone.
Sit that on an offset account. Put it in a high interest savings account. Don't put it in investing because within the year, 18 months, you will need to pay the piper.
Parking it for a period of time.
So given, and this is why I wanted to touch on the other ways to get into super, if Ross and Rose were a little bit older and, you said if there was a $600,000 mortgage, let's assume there was a $200,000 mortgage because they've had it for a while, they've paid some of it down. So we've got the $978. So we've allowed for personal income tax of the portion that's CGTable.
Yep.
We've put $90,000 each into super.
Yep.
We have to then take off $300,000 mortgage?
I say 200,000. 200. What you said.
We'll just say 200,000 mortgage gives us $598, $600,000.
Yep.
They've got their home mortgage paid off because they're smart and they only want a debt that was deductible on their tax return. Oh, actually, this is where assumptions get really bad. There will be a portion of that year where there might be some rental income that needs to lob back on the tax return, but also a portion of that year where interest and other costs will be netted off. So this is why it's just high level, people, high level.
Yeah.
So we've got $600,000 each, and they're like, oh yeah, we're 55, 56. Let's invest this money for the future.
This money's for our retirement. We don't need most of it.
based on they can then rock up and put 120 each into super.
As a non-concessional contribution.
Now, we talked about carry forward. What's the other non-confusing word?
Bring forward. Yeah.
So bring forward, we can bring forward 3 years of the 120.
Correct. Yeah.
So they can basically put 300 grand each into their own super funds because of this.
Yeah. Tax-free, like they've already paid the tax on the capital gain. This is after that.
Yeah.
They can then go and put 300,000 in each as a bring forward non-concessional. They don't save any more tax, unfortunately, but when that goes in, they don't pay any tax when that goes into super. Why would they do that? They're isolating it for their retirement money, but also it means the future earnings on that are taxed at their super fund tax rate
15%.
rather than their personal tax rate. So if they just said, we're going to leave that in a term deposit earning 5% a year, which perhaps is not the right strategy longer for, but again, separating the structure versus the investment. If they kept that in their own name earning 5% a year, they're going to be paying income tax at 32% every year on that. If that's inside of their super fund earning the same interest, 15%.
Earlier, I flagged an assumption that their super was under the 500 grand. Why did I do that?
You can only use the carry forward, the first one we spoke about of the extra bit to save tax. If your balance is under 500,000 on the 1st of July in the year you're making the contribution. And I added that extra boring, nerdy bit at the end.
Yeah.
Because that is the boring, nerdy bit that people get tripped over on. The balance of your super has to be below 500,000 to be eligible to use those carry forwards.
If they were 75,
they cannot do any carry forwards unless they meet a work test.
Or bring forwards, rather.
If they're 74, they can do bring forwards. If they're 75, they've got 28 days after the month after that. But let's assume no.
Okay, cool.
You
know what?
Other than a downsizer. You can do a downsizer after 75.
You know what? This is wild. At the risk of stroking my own ego and giving you a compliment. My analytical questioning really suits your technical ability.
There we go.
Do you reckon? Like, because I'm thinking about all these weird scenarios and just throwing them at you. We're just the perfect pair.
Yeah. You can be the retire and I'll be the right.
Yes. Because you're always right.
Advisor.
And I'm retired. I'm a retired financial advisor. Now, if they didn't have a mortgage, they got 800K, basically, carved off 200 for contribution and tax.
Yep.
We want to get it all into super. We're not doing $360,000 now, are we? We may do something else. But if it is May, what would we be doing?
So that bring forward, and I'll add this detail to then answer the question of, if you do 360, what are you basically doing? Is you're doing 360 this year and then you can't do anything more for the next 2 years. So you go 120, 120, 120.
Done.
Or you go 360, 0, 0. It's still the same money over 3 years, but so it's not extra money into super, it's just bringing it forward. So
or you can do 120
and then
360.
So why would you not do the 360? Is because if you do 360 in May, you can't do anything more. So what you do is you do 120 in May, you wait till July, even though it's only a few weeks, it's technically a whole new financial year, and then you're done. So you put 120 in for the husband, 120 in for the wife, that's 240. Then in July, you can put an extra 720,000 in, which is 2 lots of 360. So that more than covers to put in what you've got from the proceeds of this, and potentially even a little bit extra down the track if you need to.
Yeah.
So that would be the way that we would do it. And particularly, the closer you are to 60 or over 60, particularly over 60 is somewhat a no-brainer, because if you change your mind, you can get you can pull some money hands on some money,
Now, drawing full circle, this is their one property. Obviously, if someone was in their 50s, 60s, and they had more than one investment property, that's when the strategy can really kick in, can't it? Because it could be like, we do this now, that one, that's got the less gain. Okay, we'll do that one in 2 years that has the more gain, but you will be retired from the workforce because basically the gain lobs on your taxable income. Would rather lob this big gain on our taxable income when there isn't 100 grand from employment. So that's why strategy is everything. And good advice and good strategic advice will pay for itself.
Time and plan. We've got a lot of clients that were, and even that, again, sideways. Many people think a financial advisor, they just look at my super or my investments. Many clients that we work with before and some that have come from the podcast have property portfolios, and that's exactly the planning. I've got a property portfolio worth X, 1, 2, 3, 4 million. I've got 2 million in debt. I want to retire in a few years' time. How do I get from where I am today to retirement? Well, all of these have capital gains, so we're not going to sell them all in 1 year. The surplus money, how much do we pay off debt? How much do we put in as concessionals? How much do we put in as non-concessionals? We don't just wait till you're 66 and retired and sell them all in 1 year, because the non-concessional limits are use it or lose it. And so exactly to your point, we need, and we've got some spreadsheets and projections and calculations that we show and we map that out. Perhaps we sell one property every year. So much goes towards debt reduction. We definitely prioritise the concessionals, and then maybe have some go in as non-concessionals, and we map out a strategy over a number of years as well.
For the new people here, sorry that we did get really technical. These limits, they're a global level at your TFN level, not at
per super fund.
Not per super fund.
Yep.
And that's kind of, I mean, we've recorded 3 episodes today and different case studies, and we've talked about multiple super funds. There are things that we've talked about in previous weeks that are at a fund level, but these caps are the global level, and that's kind of another consideration.
Yeah, and I think that's where, oh, sorry, I forgot to tell you, I already put $1,000 in because someone said I could get the co-contribution. Probably important to factor into this 120, because if you put 121 in that year, you can't do the bring forward the next year. The only other bits that I'll add to that, because I do like to add more detail or help when necessary, if you are above the 500,000 and you've sold a rental property and you've got more than that in super, can you still put some in to save tax? Yes, but you can only go up to that year's cap of 30,000. So you can't do any more carry forwards, but you can definitely still do that. You can do that up to the age of 67, even if you're not working.
So at the moment, on the 1st of July, the SG rate, it's the end of the legislative line.
Correct, yep.
And it stops at 12. So over the last 5 years, it's been tapering up from 9 to 9.5 to 10, blah, blah, blah. So we're at 12%.
12,
there's nothing else tabled to increase. I think they probably would want that go to 15 at some point.
I think in 20 or 30 years' time it will, but not
at this point,
not in the next few years.
We're done. In terms of the concessional and non-concessional caps, they are pretty much every 3 years they get indexed.
Yeah, it's based on a WOTI.
A WOTI, yeah.
Yeah, but there was an increase last year.
Yeah.
We're not going to probably get one in FY 2026, but I would expect that probably the year after that will go up.
And those tapers flow through like a conveyor belt with the carry forward.
Yeah, and that's where we've used your fair assumptions today to make it even less technical. But you can't go, okay, 5 years by 30. And the good thing in that regard, either yourself on your MyGov, your accountant, or potentially your financial advisor, there's an ATO report that summarises in a nice little table. It's definitely got some tweaks to it, or I suppose some things you need to understand, but it will show you the last 5 years, what the limits were per year and how much you put in per year, and therefore how much carry forward is available per year.
I would also try and get your advisor to cross-check that with your own data.
Super funds and data.
I just get a bit gun-shy with... I logged into my ATO portal the other day. It said I've got $111,000 in super.
Well done. That's
it's
good.
not that. I can tell you right now. It's not less than that.
Yeah.
You know what I mean? Like,
Yeah. There's definitely
that's
some-
categorically incorrect.
Yeah, and on that, we can nerd out that Wayne, an advisor in my office, were comparing some notes yesterday because there were some inaccuracies. And it wasn't, I suppose we've agreed that it wasn't actually less of an, or more of an accuracy, more of a timing issue. Because back to when your super fund tells the ATO the data,
Yeah, when the super fund level does the tax report.
if you've done a notice of intent to your super fund, you go, I've told it my super fund, it's come on my ATO pre-fill, it doesn't come off your carry forward report yet. And many people I've seen get tripped up on that. And the reason it doesn't is that because you get the chance to vary it. So it's not actually until you've lodged your tax return, then it gets adjusted. But that might not be till you might be seeing an advisor or your accountant in February about your rental property sale for 2020, the year you're in, but you haven't done last year's tax return yet. So those figures, I forgot to tell you last year I did that, I just haven't lodged my tax return yet. There's definitely some
And I
detail
actually
there.
think I know the reason, because you're right, it is a timing thing. I started a self-managed super fund, took some money out of my retail fund. There's obviously been a report done and there's only been $100,000 in there.
Yeah,
And
but the other
in a
hasn't
couple
been
of
updated yet.
And the super fund hasn't done the report, the tax
Yeah.
return yet. Come on, Paula, let's get it on.
Yeah.
Not that it's urgent, don't care.
Yeah.
But it will wash up,
Yeah.
but there is a lag.
But yeah, if you're, and particularly, and back to we said, your balance under above 500,000,
How do you know?
exactly.
So the risk is, Martin, when it does wash up, if it's more, will you get pinged?
Yes.
Right. You've scared the living snot out of me on behalf of listeners who see this stuff online, look at their own ATO, transfer money in, they could get pinged.
Yeah.
So it is a timing thing. I think go back to your own super fund, do your own year-on-year records, because I would imagine each of the major super funds, they're going to be doing their tax fund reporting to the ATO different times.
Yeah.
Particularly if you have different funds.
Multiple funds, and like you said, SMSFs can be different reporting, and even that you're referring to the total super balance report. The timing of that is different to the concessional carry forward report. There's a different employer contribution report. There's a bring forward ATO. Like there's 6 or 7 reports, and they're all great, but they've actually got different timing elements to them. And until you do this day in, day out, you don't get to learn the differences to keep an eye on.
Well, there you go. Well, we'll leave it there. One last question, Martin. We've gone back to back. We missed lunch. It's 2:45 p.m. I'm going down to Macca's to try one of these Tennessee barbecue burgers. Will you join me at Macca's?
I'm going to get 2 or 3 of those, I reckon.
Do you eat Macca's? Will you? Do you want to come and smash a burger, or are you just going to hit the road?
I will skip the McDonald's
He's
offer
so
that you
healthy.
kindly offered to me.
He's so healthy, but he does marathons and all fitness stuff. We'll leave it there. Martin McGrath, Financial Edge Group. Thank you so much.
Thank you, Glenn.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.